So hello, Brian here. Going to show you guys the reports here, gold future options we're going to focus on in this PowerPoint. Um, so I've kind of put up some detail on the first report last week. If you're not on my email list, I'd probably do that. You can go to quantlabsnet.com to get subscribed and see how I'm rolling with this stuff. Okay, so let me continue with what I'm saying. Disclaimer. This is important to understand. This is a brand new concept I've come up with. I've spent the last 4 or 5 months on this. We're using real futures option data from interactive brokers, but the options chain data is simulated. Okay, I want to make sure people understand that. Okay. So the other caveat here is not investment advice. What you see is not to be used to forecast with because you see something. This is not the place for it. The other big thing is because this is the first time I'm showing this, there's going to be a lot of weird things going on with the data. And yeah, it's just going to get kind of weird. I'm just going to see if anybody's in my waiting room. So I'll probably have to do this from time to time. I don't see anybody in the room. Um, I'm supposed to have access to my chat. I'll open up the chat once I'm done this because I'm kind of overwhelmed by be running this webinar by myself. All right, so a couple things I'm going to show you here. I'm going to assume they kind of have a knowledge of futures and options. If you're not, don't be confused by it. But this is coming from an approach of what HFT shops are doing, like high frequency trading shops are doing, hedge fund shops are doing it. Some of the bigger institutional multi billion, I'd probably say, versus multi-million. Okay. I've already mentioned the cost for the option chain data coming from the CME or ICE exchanges. As I said, you're running anywhere from 2,000 per month to 4,000 per month with 1 year term plus licensing fees. So it's not cheap here. So what I'm going to show you here is right here. What a lot of these shops focus on is arbitrage and hedging. This is kind of like laying down a future floor price and then looking at what types of options are available for basically unlimited potential in profit. I'll explain that a bit. That's what really appealed to me. So this report basically is going to look at, and I can go in detail with each report. As I said, I'm going to have one available for gold. That's what we're starting with. I can show you one for ES, which is the S&P 500. We can also do another one for the oil as well. Um, okay, so basically what we're going to look at cover call, should not cover calls, put options, call options. We're going to look at different predictions here. We're going to look at the big one that a lot of the firms will use is optimal hedging, looking at hedge effectiveness. And this is just one snapshot. What a lot of the HFT firms will do, they'll simulate this sort of stuff in probably AI using a lot of GPUs coming up with the optimal hedging if that's what they're going to use on top of layering it with arbitrage. Um, Again, I'm going to show you different arbitrage opportunities from this and the different types of data you can use in options, be it in Greeks, specifically in time value. And I am using what a lot of the firms will probably use, but not tell you are payoff diagrams. Okay, so this is the first thing we can look at. When it comes to quant, one of the popular modeling techniques, just using futures or even stock or pretty well anything, is using something called ARIMA. So if we have a price prediction, we can use ARIMA and understand these reports that you'll see are very lengthy. They're on average about 40 pages. That's how much data and different techniques are used for this. Okay. So this would be a typical 5 day prediction on where gold will go. Okay. And it's using something called ARIMA. This is classic quant stuff, nothing very complicated. But the thing is, as I said earlier, a lot of this is AI code generated. So it also includes a lot of the coding for quantitative techniques. Okay. So in this case, we can look at various profit loss scenarios as well, based on a buy price of let's say 3,000 and a sell price of 3,040. Okay. All right. So out there in the world of options, one of the basic techniques for modeling is Black-Scholes. So Black-Scholes, you can calculate things like implied volatility. That's what this IV is, and put IV. If you're kind of new to the world of futures and options, it's exactly what it says. It's looking into the future. It doesn't really care about the past. So one of the things that's very powerful about this particular model, it's universal. It's what a lot of the firms will use as the basis and come up with their own custom models, and there's a ton of them out there. But usually, what they're looking for is an implied volatility on a certain duration for both a call or a put. Okay. They will also look at the different types of option pricing as well on a put or a call. And they'll also look at factors when it comes to the options world, if they're going to look at the typical strike price. And the strike price is issued by the exchange. So you understand that. I first was using a real world strike price, but I got to a point where the AI, it's so sophisticated, it can calculate its own strike price and it's trying to mimic a variety of simulated strike prices. And you'll see how it works in the option chain data. And then, of course, we are using all the future prices I'm using are real world pricing. So this data came from a snapshot at the end of March, I believe. Like gold is like on fire right now, as you know. Okay, so now we're looking at the very, very valuable chain data, option chain data. So in this case, we could say, well, our current input price is $3,100. And then we can look at, are we in the money, meaning are we profitable? Are we out of the money where we're not profitable? And then at the money, meaning we're kind of there. And then you have some fairly sophisticated techniques using Greek analysis where you could use things like a delta, which is option price sensitivity on the underlying price change. And that underlying price change refers to the futures price uh, in the futures market. And then there's the spot market, which is the cash price as well. So along with that, we have our gamma, rate of change of the delta. Then we have our theta, which is a time decay on the option value, which is usually negative. And then the vega, which is a sensitivity to the implied volatility. If that doesn't confuse you, we've got lots more to confuse you with. Just so you know, I do have a course on this. It's a 5 week, very detailed, very lengthy course, but it kind of gives you an idea how this works. If you got questions on it towards the Q&A, I can definitely cover that for you. And as I said, it doesn't stop there, my friends. Doesn't stop there. So as I said earlier, we're moving into hedging and fundamental and then using something called basis risk being, and I'm going to make sure I got my date down, March 14th, 2025. There was an alert put out last week from the Federal Reserve. Cash carry said, if we have liquidity risk, we will step in and provide the liquidity means, well, we're going to print more money for you. And their debt situation just, well, it just, it's that death spiral they're talking about with what Ray Dalio talked about. I think that came out yesterday. But this is what they're afraid of is the basis risk on the treasury because no one's showing up at the treasury auctions and they know that they're in trouble. They have a credibility problem. So therefore the US dollar basically broke through 100 and is starting to deaccelerate pretty quickly because of the credibility problems the US has. Don't go after me. That's what the data shows. That's what the results showed on Friday when the markets were kind of tanking. So what we're doing here is we're using a combination of futures and options to offset what we call price risk in a cash commodity position, again, the spot market. So again, here we can use a variety of techniques. We can use things like a mean cash return against spot market. We can measure things by the standard deviation in the cash market. We can measure the correlation between the spot market, the futures market. And this is where you start to get kind of mathy and quant kind of stuff, but this is very basic stuff. We can also measure the covariance. And the thing is, this is looking forward. This is forward guidance. This is not today. This is not in the past. What we want is to see things in the future. That's why the futures market and the options market is so valuable here. So when we talk about basis or basis risk, we're looking at the difference between the cash price and the futures price. And then sometimes, as I say, if you have a widening basis, what it says means there's more short hedges and the cash price will fall or move up in the futures market. We have a narrowing basis, positive for short hedges, where the future price falls or uh, it rises, meaning it goes down in the cash market or the spot market. So again, I'm going to show you the different ways to look at this in the report, because this is really fundamental to understand what's currently going on in the markets today. Specifically, what is being specifically watched is the DXY, the dollar index, along with the different durations in the treasury market. And this is where Mr. Trump will say yay or nay. We have to renege and cave on what we're putting out on the, in this case, the trade tariffs. So this stuff is unbelievably valuable, and they're watching and using this data to see where how the markets react, how the economy reacts, and the whole cascading effect. So here now we're looking at the hedge effectiveness, and all of the firms right now are lining up all types of different trades using all the different techniques I can show you in these reports, and they're judging based around that. They could be market making, they could be trading in the spot market, they could be trading in the futures market, they can be doing all kinds of option trading strategies as well. And I've got pretty well all of them covered in the reports. You'll see it. Um, so here, again, I've got a course on this, so I know I'm kind of going pretty deep on this. Seems I'm losing people here. Anyway, sorry. So we got the futures hedging. So are we going to sell a future, buy a future? Are we going to do an options heading, a buy or a call option, a put or a call, basically? And there's a different combinations to look at. We can also look at arbitrage opportunities as well. Do we do a cash and carry? Now, when it comes to commodities, specifically, let's say agriculture or gold is a good example. What's happening is the gold is people usually roll it over and just say, I don't need the gold bars. I'm good. And just let the new futures contract or whatnot roll into the new one. Now, what they're doing is they're putting what they call standing orders in. This is now the Federal Reserve, the central banks basically saying, I'm putting a standing order. I want my gold bars now. That's what they're doing. And now usually it takes like 2 to 3 days to fill. If it's in the LME, the London storage, or most of it's in London or Switzerland, and it's starting to come out now in quiet ways. It usually takes 2 to 3 days settlement, and now they're up to 8 weeks of settlement. That's how much people are now putting in, panicking. They want their gold. Germany wants their gold. U.S. wants their gold. So that's what's going on right now when it comes to the holding cost, the storage cost, and that can be right across physical um, commodities, and gold being one of them. So obviously, what we're trying to do here is we're trying to develop a strategy on the current day situation to understand what kind of option or combination of options or with futures. Okay, and with all this, you can measure the potential profit as well. It's this sophisticated. On top of that, you can get a general conclusion from the combination of what kind of strategy you want. And I can kind of show that in the different scenarios that are in these reports as well. So here we could do, let's say, options arbitrage. So for instance, we could do a put call parity and do a check on that in the equilibrium. There is an equilibrium between a call and a put. I'll show you that in a chart. And again, we can do all these different types of scenario analysis for this. So there's different things that can be in conflict because There's live data, and as I said, I'm because I can't afford the option chain data. I am using simulated data as best as I could, and I think I've got it as good as I'm going to get, courtesy of the AI, where we're at with the AI as it stands right now. And again, you can calculate projected dynamic P&L profit loss, or um, a dynamic a dynamic P&L, or we can do a static P&L as well, where we have a P&L on the short or a P&L on the long, whatever we decide to do. And then we can get into interesting things where we could do hedging for if it's a farmer, if it's for a producer of a commodity. Obviously, when they go to market, when they harvest something, they have to understand they need to protect their price if the price collapses. So they'll go out in the futures market and try to buy a future, to protect their what they're going to sell when they go physically to sell in the futures market. So again, there's things like we can measure premium, gaining of value at expiry on an option. We can use theta as one of the Greeks to analyze as the option's about to expire, blah, 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 blah. And you can measure that day by day, and well, you can do it in real time as well. So there's different scenarios that will come up with. Do I do a put option? Do I do a call option? What happens if it declines? What happens if it increases? What do I do? And as I said, there's a strike price as well, and there's a combination of trade-offs with that as well. And you're going to use the strike as well as a measurement. And as I said, that is a typical measurement used by firms and independent traders. And when it comes to options, you can sell or buy an option. It gets pretty sophisticated. I think this is it. So hopefully I still have people here. All right. So, like I said, in summary, what I'm showing you, it's very, very sophisticated. So I'm going to show you one of the reports. Um, so as I said, a good example is using ARIMA modeling to forecast futures price, or you can also do the same thing on a strike price as well. Believe it or not, you can use Black-Scholes model to calculate different put call option, or sorry, call option, put option. And you can also do the typical math to figure out what the implied volatility would be. Then we can do things like hedging analysis for if there's a negative correlation or if there's a positive correlation against whatever. We can also measure what you're probably hearing now, the basis risk on Treasury. Um, then we can also use all this to provide this keyword here, certainty, before you put your positions on. And there's a variety of different ways to bring in flexible protection if you want to maximize your profit potential. And then again, you can layer it in with arbitrage as well, to identify different scenarios that's available to you. And then again, with the options, you can do your calls, you can do your puts, and get your downside protection as well. And that is all. So I'm going to stop the screen share for now because I think, all right, so I'm back in the chat. If you guys got any questions so far, let me know. And I'll go back in the reports. Anybody got any questions at all? With what I presented, because it's going to get more sophisticated when you see the reports. And again, what I'm about to show you is just early days of what I'm going to have as a final report. As I said, each report is each market. So I'll have one report for gold. I have another report for, let's say, the ES, which is your S&P in the futures market. I'm also going to show you the CL, which is oil as well. Anybody got any questions? If not, I will. Oh, there is a question. Can we get a copy of the slideshow? I'm actually, if I don't know if you want the PowerPoint slideshow, or this is a recording and it'll end up on YouTube. I don't know if that's good enough for you, David, but I can definitely do that. Just let me know. Okay, thank you. No problem. All right. So anything else at all? I might have to provide my this is all kind of messed up when you see the video. It's the way it's recording. Um, any other questions at all? If not, I'll go on to the next phase of what I'm going to show you. Okay, just give me a second here. I'm going to load up a couple of reports here. So what I'm about to show you is the reason why I spent all this time so far on this. So I'm going to go back to my share screen. Okay, so let's go back to our share screen here. Um, okay, okay, here we go. So I'm going to take you now to a couple of reports I'm able to generate that are not pretty, but they will be pretty eventually. So you can see my screen okay? Anybody? Just give me a holler yes verbally. Anybody can see my screen? I'm assuming you can. Okay. All right. So I'm assuming you can. If you can't see anything, let me know. Um, all right. So in here, oh, wrong one. Okay. In here, I can right now track 41 commodities USA specific. Okay. So in there, I'm going to add in Japanese yen. I'm going to also add in the euro dollar. I can also do crypto being Bitcoin, Ethereum, and I just confirmed they've added now Solana as well. I think a couple other ones are going to get added as well on the CME for the different coins. So that's coming. But for right now, there's Solana, Bitcoin, and uh, Ethereum. The thing is, I just want you to know TradingView right now, because we're coming up to Easter, is having an 80% sale off on TradingView. So if you want to be able to get access to probably one of the best platforms out there, I'm just letting you know that there is a special on right now with TradingView. Okay, that's twice a year they do that for that type of discount. All right, so let me show you the gold report. Now, right now they're in Word, but I'm going to probably format them in PDF. So, any questions? Let me know. I don't see any questions so far. Okay. So, what you're looking at now is the first version of the report. This is constantly being improved on. This is constantly being it's going to be improved. I'm if you guys any of you guys are options traders, let me know. Get in touch with me via email or the chat. I want to talk to you because I'm going to be running a quote unquote beta program to give people access to these reports to help me validate them, to see if the data is working and working as expected. So I'm running that right now. So far, I got, I think, one person interested, but I will go out and post these as jobs for options traders. So, yeah, it's hard to find options traders in the futures market that want to get involved in this. Okay, let's get involved. Let's present this now. So this is the um, annual volatility. I have capabilities to show the daily volatility for the last 20 days if I want. What you'll see with this is this can overwhelm probably within the first two pages. And as I said, there's about 40 pages to this. Okay, so one fact, I think the big trends will be happening. People are going to want to find anything not correlated to uh, the the stock market. No one's going to find anything to do with the dollar. No one's going to want anything to do with the treasury, and no one's going to want anything to do with crypto. That's moving forward. So then you go, gee, what's there to trade? That's the beauty of the futures market because now you're dealing with. I just talked to a futures trader, and they're up 7% because all they trade is the meat market. So what the trend will be over the next probably already is looking for uncorrelated to all those assets that I mentioned: treasury, dollar, um, gold, dollar, treasury, stock market. Those the big ones. All right, so volatility is going to be a big factor. Okay, um, that will be a massive measurement. Is going to be volatility because people are going to start looking for lower volatility. So for an annual of gold at 16%. That's fairly low. Usually you want to have the treasury, but we know what's been going on there as it exploded last week. I don't know the future because I'm not a fortune teller. But yeah, I expect there's going to be big time volatility come into the dollar and treasury market as well. So as I said, the first thing, this order I'm going to show you will change most likely. But the first one right here is the options pricing on the Black School. So typically I have to feed in um, the data in the model to get a result. Sometimes I have to keep it in a certain order so that if I don't have a strike price, well, I have to go out and calculate it and have to simulate that. Or do I have to go out and da 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 da, as you can imagine. So some of the data like futures price and the cash price I can get right now because I have access to it. When it comes to strike price, I can do it, but I have to eyeball it. And in order for me to automate the strike price on an option chain, that's when you start getting into that very expensive option to get access to the chain data, option chain data, which I said can run you into thousands per month. And they do that on purpose to keep us little, I guess, call ourselves the peons out of the market. That gives them that trading edge. So as I said here, what I'm using is the put price, the call price, the futures price, and the strike price as well. And then you also have to give it the time to expiry. So in our case, it'd be quarter of a year, which is 3 months. That's pretty standard. I can feed it whatever I want. And we can also feed it the risk-free rate as well. Many people have different ways of measuring risk-free rate. In this case, and I can change it anytime I want. Thankfully, this is universal. It could be a 1 year fixed. I'm using a 10-year risk-free. And with a treasury the way it is, how do we know it's risk-free the way it's going, right? And then we also have to feed it the volatility as well. So we'll be able to get a calculation out of that. But again, some of that's simulated as well. But if I can get access to real world through option chain data, all these calculations that I'm showing you simulated is no longer simulated. It's actually true forecasted as well. So one of the things here is we want to predict our floor price using, as I said, the ARIMA. So if I do a 5-day prediction, okay, so in the chart here, what you'll see is this is a typical pricing of gold. Okay. So right now I ran this I don't know, hours ago, like at 5:30. And right now you can see that's the typical price for the last believe yeah, year. And you see here in red, this is the ARIMA calculations, which is basically measuring the future direction of the futures price. So it's pointing down. And that's kind of probably accurate because if the stock markets come back, obviously gold is going to decline. All right. And then there's going to be all the people going to be jumping in the gold market and probably going to start losing money. So again, this is part of the problem when you're in the stock market. And then it will hit and have your gold price decline. But again, we are in new territory. Nobody just knows where the gold price will go. So the next thing is when I said about hedging, this is the typical hedge math that you have. You have both the futures price, the cash price, which is of the commodity, and then you're able to calculate measuring on time the mean cash return, the mean future price. Also, you want to calculate the variance of the two, and you also want to be able to measure the standard deviation of both the cash return and the standard deviation, along with the covariance between the two and along with the correlation as well between the two. That helps you measure for the futures market. But what I'm understanding now, a lot of people don't want to go into the options market, which is fine. But once you understand it, you'll go, oh, it's not so bad. Well, it depends, but you will see the power that you get with better forecasting when you start to look at the options market. So in this case, what we're trying to do is we have our future price. And the reason we do that is to use when you'll see moving in the report, we use the futures price as our downside for our downside protection. And I purposely put some of the insights and why you want to do that. So as I said, we have our call it hedge math, okay, and then we come back to trying to calculate our implied volatility using what I just fed it, and then using the Black Scholes again, we can measure the implied volatility of both a put and a call. Okay. And then we can go further again using all the data and calculating all that. So let me just see if there's any questions at all. Any questions at all? If you want, just verbalize it uh, in the audio if you want. Okay, so now this is all the nitty gritty stuff. This is the juice of it all, the important stuff, the gold mine we'll call it, the gold mine of the gold option chain data. So here how we calculate it is it's kind of gets kind of wonky. It took me a couple of days to generate this on a simulated, but I was able to do it. So let's say you have a current futures price at 31.47. We have to give it like a step size as well. So it's when it's calculating and how are we doing each iteration on the chain and what's the iteration for the strike price for each simulation on the measured strike price. This is what I got to still work on to unify it. So we have, let's say, $10. We can say, okay, let's try to measure out a 1 year. That's kind of unrealistic, but it could be a month, 3 months. Usually that's the best. And sometimes up to 6 months, but usually 3 months is good. So you could see here if we, this is where you get into the simulation on the strike price. So we're able to see, okay, if we're moving ahead, where are we at? Are we in the money? We out the money? And that's where the moneyness comes in, basically the forecasted profit. Again, this is a very simple simulation. Okay. So then we can use all of this stuff to measure what pricing we want on the option chain data to measure our option call to set the positions at to be able to measure what's our break even price using strike. And you'll see that in the charts as well. So in here, we're looking at the detailed option chain. So in that, we have our strike price right here. Then we have the call side and the put side. And each call side and the put side, this is a typical table you'll see in high-speed trading systems and platforms as well when you see the quotes of the bid and ask. This is kind of similar to it, but we're also including those Greeks as well, the rho, the theta, vega, gamma, and the delta on each side if it's a put or a call. Okay, that's pretty important stuff. I have it more sophisticated, but I can only do so much here as well. But that's very helpful when it comes to option chain data. But again, it's simulated. All right, so then we get back into the Greek analysis on the calculations. And again, I mentioned them already, delta, gamma, theta. Um, and then again, we can signify very interesting insights on the option chain data. So if you're using delta, which is the top two ones are theta, which is the time decay, and the delta, which is measuring the change in option price for every dollar in the underlying price. Again, that refers back to the futures market price. So in there, we're going to get a positive delta on a call and maybe a negative delta on the put. Okay. So there's the gamma, again, measuring the rate of the change of delta. So you can go deeper than the theta, which is the time decay I mentioned, and the vega, which will measure the sensitivity on the theta, on the time decay. So this is where the real meat of it all. This is the meat of it all. To know if you have a trading opportunity in the options market and being able to combine it with a futures market. There's something out there, and again, it's all it's all projected. But this is what a lot of the market makers use in high frequency trading. This is what they use called the call put parity. And it's basically an equilibrium in the markets with the option and the call. I believe this might be accurate what you're seeing. But what you want to see is you want to see an equilibrium between the the call and the put. Okay, using the put and the strike and this PVK. Okay, so again, you can do a calculation on that. So what you want to see that tightness between the two on the put side and the call side. Once it's out of whack, that's when you have an opportunity for hedging to protect yourself or to do an arbitrage to make profit. And you could do that again using all these simulated measurements. But in this case, it only lasts for maybe a second or half a second kind of thing. And that's where the HFT comes in, the high frequency trading, because that's what they look at on this equilibrium. And as I said, that's the basis of it all. Once the equilibrium's out of whack, you'll see the HFT shops come in and start trading that. And another big factor that's measured is um, how long it lasts as well. But last week, a lot of people made money when there's chaos, and this is all measured by volatility. So when you have all this no clarity in the markets that puts things out of whack, this is like a trader's delight for a trading opportunity on the low level, and they're making big profit. You won't hear them complaining. So then there's another thing called risk return frontier as well. This is where the risk reward comes in. When you ask any retail trader, can you define it? Blah blah blah. They don't know what they're talking about, but this is where it comes from. And using these indifference curves as well on the different simulations as well. And then what you're trying to do is you're trying to find your optimal price with the expected return and the risk measurement on the standard deviation, if that makes sense. I still have to understand I'm not here to be a quant. I'm just showing you the type of data that you can use to really get really good at it and be able to project not just when it happens, but where you can trade on the close, sorry, on the open. And you'll see later on the charts on the payoff diagram and when they get out. It's it's awesome. That's all I can tell you. But you have to have a fairly big, sophisticated account to really take advantage of it, and to have the know-how and have the technology to throw all this data back to you. A lot of trading platforms don't provide this. They don't provide this on purpose. Not a lot of. I don't think any trading platform does this. You can probably do something like this in TradingView or custom with interactive brokers, but there's a lot going on here. There is a lot going on here. So again, what you're going to see is the bed of it all is the payoff diagram. So here is the risk frontier to measure your risk on forecasted trades, and it's these little dots to figure out your optimal entry point on your future or option as well. All right, so here's the payoff diagram. So in the payoff diagrams, these are scattered throughout this report. Okay, so we're right now, I don't even know what page we're on, to be honest, but it doesn't matter. This is fun. So with the payoff diagrams, these are supposed to be dynamically generated, meaning if you're an HFT shop, you'll be pumping these out all the time and you can turn them into 3D. And that's what I did with that video with I put up on YouTube. Again, that's 100% open source and generated by AI. But if you want to get very sophisticated charts in 3D with what I'm about to show you, you can kind of do it. Um, and the best charting package out there is what I'm getting access to is the lightning chart. And lightning charts would blow your mind on anything that you've never seen before for this. And lightning chart builds they're charting for this for the sophisticated trader, and they just brought out a Python release because everyone either focuses on .NET or they focus on JavaScript. But this is the first one where you get actual Python support. Okay, so the inputs for the payoff diagram include the following: expiration date, call premium, max price, and you can easily get that through your simulation on the options, or the max price through historical data set that you choose. As I said, I'm using 1 year look back. Then we have our lower premium as well, and our higher premium, and that's the premium I talked about. and all the different types of strike prices on the lower or the higher, the premium as well, and the call strike as well, and the put strike and the number of strikes. This is the payoff diagram. What you're seeing is, because I know just somebody just mentioned, a lot of people live off of the technical indicator charts. It's commonly known in the smart bucket world, smart dollar world, smart dollar. No, they don't trade like that. You cannot forecast what's going to happen in the future on a stock or an ETF using basic technical indicators. That's where you put yourself in the dumb money category. And the reason for that is because I'm showing you exactly what's going on both the options market and the futures market in parallel together to be able to quantify how you want to set up your strategy for whatever set of positions you're going to be able to do it. And as I said, you're going to see you'll be able to do it in an optimal way. It's going to be hedging along with an arbitrage. And at the same time, you can set up if there is an opportunity with arbitrage, and I've already shown you the quick call parity as one way to measure it to know if there's an opportunity or not. You'll see in the oil that there is a classic opportunity there because of the dropping price in oil, and that's been kind of been in play for a while now. So that's where I think a lot of the HFT shops are trading, and not gold, not maybe treasury as well, but definitely in the oil market because that call parity is so it's vast. Anyways, let's
Hey
go ahead.
Brian, I saw Goldman Sachs had record trading announced for the last 3 quarters. Be interested to find out what they're trading and where they made the most money.
Well,
Just keep it in
I
mind for
can,
later.
yeah, we can talk about that down the road. Um, Goldman Sachs, just so you know, has just talked about. I think they've fallen behind the likes of Citadel, Optiver, all the big shops. And now they're starting to go into HFT and starting to build out medium frequency and high frequency. There was a story on that last week. They just poached some dude from I think it was Citadel. There's a lot of poaching going on between Citadel and Goldman Sachs, and they're paying some pretty good money for it too, like in the millions. Anyways, so here in the payoff diagram, what we got going on is here we can measure the floor price on the futures. That's your downside protection. That's what you want to measure your minimum risk. And then you can use the strike price right here to use your long call for your payoff. And what the ideal is, depending upon what side of the market you on, are you a seller options or are basically a speculator or a what do you call it, speculator or a hedger? If you're selling options in the market, you want whoever's buying the option to lose. You will make money on the premium. That's how they collect income. But woe betide you if the trade goes against you. You better be able to cough up uh, what the buyer's getting on your losses as the seller of the option. All right, so continuing along here, the ideal what you want in this case is a long call option. This right here is your floor price on the futures, and this right here is your premium you're going to pay out for your long call option. This right here is you're going to do an arbitrage along with some hedging, protect yourself on the downside protection, and then use the option, on whatever side of call put, and use that option to have virtually unlimited profit potential. But you also have downside protection. We'll go into the maximum risk you take with an option. All right. So hopefully, if anybody's got questions, just chime in. But we'll get to all the outside stuff. Okay. So this is where it's going to get really hairy. As I said, this is early days for me. Here, I'm trying to present multiple option strategies you have on what's being presented in the data for options opportunity, along with a futures and options or options opportunity combined with other options that you can use for put, call, or put, which you call a synthetic option as well. It can get fairly sophisticated here, but this is for big accounts. So along with the day, we're right now looking at what they call bullish strategies in the world of options. So this is the first one. There's a bunch of them, and it gets very complicated very quickly. So these are the simple ones. So if you expect, based upon the data, if it's going to be a bullish call on your let's say call option, that's what you do. So you do a simple call option. You can also do a bull call spread, and it gets kind of wonky, but it gets tighter. And again, you won't be able to see these strike prices in parallel on a lot of platforms. I can confirm on the TWS, it doesn't show the strike price on these different types of trading opportunities. And these are strategies that you would get on a trading platform. This one would be a bull put call spread. And see here, you can measure the put call spread payoff in this cyan along with the higher end, lower strike. If you have the real strike data from the option chain, again, that's where you got to spend your thousands of dollars per month. So in this case, we're now looking at bearish. So if you're now going into an economy, everything goes down and it goes hairy, and you know it's going to be a predictable move, you can use a bearish strategy, putting on a put, and you can also look at the payoff and say, okay, my future minimum has to be this, and then you can look at the put as well to profit on, and then again you can look at that from a unlimited profit potential from a bearish side or from a put side. So again, then you have a bear call spread payoff diagram. Some of these diagrams I'm showing you can get pretty hairy. They may not look right. I have to verify that in the data. And again, like I said, this is simulated data because of the option calls. The option chain data is very difficult to get because, well, it's expensive. Again, bear put spread payoff diagram as well. Okay, so then you could do what they call market neutral risk as well. So if you're not sure, you can do these type of strategies. You can do a short straddle payoff diagram. You can look at a short strangle as well. Okay, this is where it gets complicated with these iron condors. Okay, with the iron condor, you're now layering in different types of option positions. So in this case, we're going to put a put strike one, put strike two. So if you have two different strike prices and be able to simulate them over a period of time with two different strike prices, we need to do that. Then we also need to measure the premium as well. And then we also got to measure out the call premium as well, because this is an iron condor call. It's either kind of tight, but once I get this all ironed out, this can be pretty sophisticated, and I could probably go crazy and give me simulated profit based upon if I can get access to the real option chain data. Okay, so there's another one, calculated iron butterfly. Again, we're now using two different strike prices. We have middle strike along with two different medium premium prices as well, and we can do that as well. I'm not going to go into detail in it because like this is like a whole nother world on these type of strategies. I'm just showing you what you can see here. So then if you're getting into sophisticated hedging strategies, what a lot of institutions use, they're going to use things like cover call payoffs or cover calls, protective puts. And this is what a lot of the hedge funds will do, along with all their own probably proprietary calculations and so on and so forth. And they do a protective put as well. Or they could do a caller payoff as well. And it just gets mindless what they can do. And these are all the different types of strategies as well. So what you're looking at is gold. Depending upon how sophisticated I get it from the code generated from the AI when I do it, as Predrag mentioned earlier, you've got to know what you're prompting to be able to generate this stuff. In January, I was fairly new at it. I'm getting better at it. In fact, I'm kind of getting much better at it, but it just depends on the code generated. And as I said, the best one right now is the DeepSeek. It's very sophisticated what it can generate. Um, so again, here we're using a futures floor price along with the options. So now we're getting more sophisticated. We're no longer just doing futures. We're no longer doing options. We're using both. Again, this is what the institutions use. Okay. So they're able to simulate what their potential premium would be. And let's talk about that. I think there's a chart coming up to distinguish between a reason when to take a future only or maybe do a options only. And the thing is, there's times we're going to do both. And there's a little table you'll see in this report on the different market conditions where you want to do both or one only, a future only, or an options only. You can see the sophistication on it. These are the messed up charts, right? So here's trying to determine, should I do a futures call, a futures only, or should I do a call option with a combined payoff? I got to fix that. Okay. And here you could do the same thing. So here we're doing a call, and I'm trying to do the same thing with a put as well, combined with a futures position as well. Okay. So yeah, it's pretty hairy here. So you can also do a cash put payoff. Okay, this is where it goes crazy on the chart. I'm pretty surprised I'm able to chart something like this, but I think I have a way to figure out how to bring back better charting as well. Okay, so again, I talked about um sorry, I talked about the different scenarios. So you're going to run it through a serious scenario, kind of equivalent of a Monte Carlo simulation, but this is different. This is where you really need to have GPUs, crazy GPUs, and be just slamming with all this data and bring back all these different trading scenarios and define what's the optimal hedge, what's the optimal this or that. And I showed you in the risk frontier to find your optimal portfolio analysis. It can go crazy on you. I'm not going to lie. Here, what we're trying to do is trying to do an arbitrage portfolio analysis, and then we can throw all kinds of data at it. In this case, we could look at a short call P&L. We could figure out what the long put P&L will be, and then we can figure out, well, what's the net P&L if I did both a short and a call, a short and a long? What's their net P&L going to be? And what these shops do, they're just running all these simulations. That's why they need their FPGAs to be able to output this as best as possible at the fastest. And as I showed you in the call put parity, might only last like a minute or a second, or they're competing. Like it's technology war. That's basically it. Um, so yeah, so these there's all these different scenarios as well. Okay, and the key word here is the potential arbitrage profit. So you keep running this to find your optimal. Obviously, I'm not going to do that in one little report, but just to give you an idea of if there's opportunity in the current snapshot, then we run this thing. And again, we can run this across over 40, probably 50 soon, different markets in the futures and options market. Right now, it's just focused mostly on US focused. Again, so we have the arbitrage opportunity for hedging. Here is some interesting ones where you can figure out, depending upon your portfolio. I'm assuming just one contract, but if I had $100,000, I'm willing to put on this trade. It'll calculate how many contracts I need for the option and how many units or size of the contract as well. Okay, and then they can calculate the different arbitrage calculations as well, figuring out if I do a combination of an option trade and a future trade, what's the profit in each, and also what's my cash outlay going to be, and blah, 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 right? So this is what the shops do. They just run this type of analysis, trying to find the optimal hedging, optimal combination using the payoff diagrams along with what I'm showing you here. And this is just arbitrage. We haven't layered in the hedging yet either. So as I said, it can get fairly sophisticated. Now, the nice thing about the AI is when you run these simulations and your code gets more sophisticated and the AI gets to know and you're building up that history, the result of what comes back is more sophisticated, more enhanced. It's pretty impressive what they've got as it gets to know what you're trying to do. That's the powerful thing with AI. And to be truthful, I think with what I'm showing you here, I'm not sure if anyone's showing this publicly, but the AI is so sophisticated, it's going to take out a lot of quant researchers, developers, and so on and so forth, because the AI is so sophisticated. Okay, so again, we've got an arbitrage portfolio analysis simulated again, based upon this current snapshot. And again, I talked about the dynamic static P&L. We have now dynamic P&L. Here we got static. And the thing is, it'll give you a conclusion here on the arbitrage opportunity. Is there an arbitrage opportunity? Yes or no? So the AI can give you that. And you can get that just based off the data as well. So you're not trading blinding in a blinding way. When you do an arbitrage, when you do a hedge, it's going to say, hey, hold on. We got enough data here to say we got an arbitrage opportunity here, and here's the expected amount you can make potentially. It's very sophisticated. Then we get arbitrage portfolio analysis and blah blah blah. I'm gonna speed up because I don't want to put people to sleep here. Okay, so here we can run all kinds of different arbitrage scenarios. Okay, and
You have an example of arbitrage you want to run
I've
through?
already covered that already.
Okay.
I'm gonna have
Okay.
the video's gonna be up on YouTube, so that's already been kind of talked about. Um,
All right.
So again, with the arbitrage, basically in a nutshell, it's basically you have a floor price that you're setting based upon the future call, and you may want to do a variety of different options. And also, if you're projecting out into the future using option data, that's where you play around with the data and what you expect as a profit, and be able to use tools like call parity or use this risk frontier I've already mentioned as different tools to measure your arbitrage opportunity. But that's in a nutshell. But it gets more sophisticated here, so I might be able to answer some of your questions. This is sophisticated. Okay, this is something that people don't know about. But here we can set what are our option boundaries are going to be, meaning what at what point, if I have an option premium and a future price, what can I expect the option be based upon the different future price, and be able to forecast that on my optimal uh, option premium I can collect. That's if you're buying the option. And then you can break it down on using basically different combinations of simulated forecasted future prices. So here, it just presents it where you can get your put call max, your min max, and the put using one strike price, just one strike price. And as shown earlier in the option chain data, it can go pretty crazy on the option chain. So this is just again one snapshot of it. And then you get also the call min max and the pricing on the call. We can't see the pricing area. You might see it in some other of the future reports. This is what we're after. We have here a gold area combined with a future price and an option. What we're trying to do to get our maximum profit is right here. Okay, this you want to be in the orange for your ideal option scenarios on the different premiums you're willing to pay. Okay, measured on the underlying price, which is your futures price. This is where you want to be. This is how you are able to quantify it and predict within that range. So this will give you your entry, and then it'll also be able to, in more sophisticated ways, be able to measure your exit based upon your position that you've set up with the futures and the options pricing as well. So this is where you want to be, is in the orange. So that's the ideal end goal we're after. To say, yes, I want to be here to make maximum profit based upon when the underlying price changes. Okay, so there's a hedge effectiveness as well. Okay, so at any time you can measure that. And again, what we want to know is what's our basis price going to be based upon our futures price and the cash price in the market as well. Sophisticated, yes. So again, you can measure this based upon futures price against 5 days ago. And you probably forecast this into the future as things move along in the progress of this data and how you present it. As I said as well, if you're going to do hedging as well, what will your cash price be needing to be? What would your future price need to be? The number of contracts that you need to get the optimal return, and again, uh, projected profit. So if this is really built for larger portfolios, like of probably 100,000, quarter thousand, a quarter million, this is what it's really meant for. And then again, how many positions would you need? Or sorry, how many contracts, future contracts would you need to get this profit? As well. And then again, what we're doing here in this scenario analysis is measuring what happens if the price, futures price widens both the cash and the futures, and it widens or narrows what would our basis be, and you can measure your risk on the position on what you want on your entry or on your entry. And as I said, with the goal, this chart here, how you can measure your profit potential as well. Hopefully, I think I'm losing people on this because it's getting more sophisticated. But this is what the shops do. This is exactly what they do. And as I said, they enhance it with their own proprietary modeling as well. But this is the basic gist of what these shops do. And I'm talking the high frequency trading shops as well. So again, um, what we're looking for, what would our optimal hedging need to be to take advantage of this? And again, you're looking at all the different types of positions that you need to be at. What would our expected return be? And that's using the risk frontiers I've shown before, and the risk parameters, the variance on the cash and the futures pricing, and the covariance between the two. And what would our hedging need to be with this H star? What would our ultimate optimal hedging to get these projected targets, we'll call it? And then what would our potential return be as well, and our variance of what it needs to be. If you had a sophisticated system to be able to use this data, you can do very well in the futures market. Okay, and then again, we can use like a equivalent of a hedge calculator for that. Okay, so what you're doing is you're using a combination of arbitrage and hedging in the futures market and in the options market to determine max profit and have your downside protection as well. And you can also measure if there's an opportunity for the arbitrage and the hedging by running all these simulations. So basically, what we're doing is we're measuring the impact of the hedge, okay, on the profitability. How many contracts? So for me, being the little uh, call myself the poor person, how many contracts would I need to measure to get 100% on that position hedged? Okay. And then again, we have different trade offs as well. So if we have more contracts in the futures market, we have better protection, which includes higher cost, but it limits the upside. Or the smaller amount of contracts we have in the futures market, we are lowering our downside protection if the price drops in the underlying market. And then again, we take a look at the basis risk as well. And we got our narrowing basis and different scenarios as well. And what we want, if you can, get that perfect hedge. And then we can start looking again at the different hedging ratios. Okay. This is where it gets sophisticated quickly, if not already. Okay, I could go on and on and on about this. Okay, so Um, here, what we're doing is we're measuring what's a strategy going to be for the ultimate options trade combined with a future. So we're trying to build out a strategy. Now, to do this from a human perspective, you could do that and be glued to the screen. Obviously, you want to be able to program it. Now, with the sophistication of where AI is at, we are now at that moment where you can build a custom pricing pricing engine for the specific strategy with all the data we need, and I'll bring back a actual trading logic of code to be able to say, this is what I want, and I'm going to build a custom strategy using AI. I'm pretty sure you can do that. It's just conceptual right now, but I'm pretty sure you could do that once you figure out the strategy of the different combination of trades you want. Okay, so um, as I said, there's futures hedging, and call option hedging. This has got to get prettied up, just so you know. So what we're doing is when you take a futures contract is generally you're locking out in on a price. With a call option, you can set, well, you don't really set, but you have an unlimited profit potential with the options. So this right here on the cost, the minimal cost of putting on a option is basically your premium. So you pay a couple thousand, depending upon the size of your positions for this. Just call it strategy. The minimum you'll lose, or sorry, the maximum you'll lose is what you pay in the premium. Whereas if you're just doing futures only, the problem is, hey, I'm just going to turn on a light here. I'm starting to disappear. Hang on. Hopefully you guys can. Oh, there I am. Hello. Okay, so as I said with the futures market, uh, it's kind of dangerous to completely trade only futures because what happens is you can lose in an unlimited way if the future trade goes against you. Whereas with options, if you get your data right, your projections right, the maximum you'll lose is your premium. Okay, so if you know for sure on these projected using all this data, the maximum you lose is your premium, and therefore, if you know you got your data and your projection right, it's kind of like combined with that future floor price, and you put on a different set of different types of options, and it works. It's unlimited. Whereas if you're just trading the futures only, and it does go against you, and you're losing money fast, like in the last 2 weeks, you'll get a call from your broker and saying you got the margin call that everybody doesn't like. So here, uh, if there's an upside potential with the future, it doesn't compare to options. Okay. Um, so as I said, with the downside risk, that's why I'm really shocked talking to traders, like real sophisticated traders, on how and why they only do futures, because they're kind of running at a higher risk than if they just trade the options. Because, as I said, the downside risk is what you pay in the premium. That's it. If you get it all covered off. Um, so the other thing is with the futures contract, when it comes to the obligation, you're bound to the futures contract. Here, at any time before it expires, you can buy or sell off the option before it expires. Okay. So like here again, this is key. Margin requirements much higher with a future and much lower with an option. Okay. So from what I understand, a lot of the institutions, like the stat is 80% of the sophisticated trading shops, HFT shops, let's say, 80% of their trades will be in the options market because of these advantages. And there will be the odd time where they may just trade only futures. Depends upon the economic situation or the trading situation. And again, it comes back to all the fun hedge math as well. Just all the basic stuff. But a lot of shops will have their own custom modeling as well. Okay, so part of what we're trying to do, depending upon what you define as a portfolio, because it's not just hedging, calculating that, or calculating your arbitrage. If you have an arbitrage, you have to. The other big thing is you got to do your portfolio analysis as well. So it depends upon what you define as a portfolio. I have 3 portfolios. I've got professionally managed portfolio I don't touch. Call it my retirement fund. I have a smaller crypto fund as well, which I trade. And I don't. I'm not interested in crypto right now because of the crazy, unpredictable volatility that comes with it right now. Um, and BlackRock has a say on the direction of things like Bitcoin and now Ethereum as well. I'm not going to get that here, but if you got questions on that, let me know and I'll tell you. And then you also have my other fund is interactive brokers, which I'm doing equity in for stocks and ETF. Right now, I'm not trading it. I'm actually losing money because I'm a Canadian holding US dollar. I've already lost 7% in the last month. Um,
You need to use your
what's that?
futures, man. You should get a futures contract. You
Yeah,
fix
but I'm
that.
not. But that's the whole thing. I'm only doing equity. I'm just starting to go. Okay, I'm going to move into the futures and options and put in a bit more money, maybe 10K, 20K, just to start with, see how it goes. And minimum risk. I'll only do the minis and the micros. See how it goes, and if I once I start to get comfortable with it and I got predictable results, I'll gladly scale it up. But right now, I'm not trading futures and options. Um, but I do trade um, the stock market and the ETF and stocks. I mean, that's easy, right? I just throw some money in the markets. It's going to go up no matter what, right? So you know how that goes, right?
So 20 minutes ago, there was the Korea, Japan, and Australia Open. So I did a 5 lot of the micro ES. Just made seven
Good. Yeah.
points.
I mean, dude, you're on fire. We're right now,
Just pattern
we're right
recognition.
now on gold, um, and I will show the CL oil and ES. So I'll show the ES next after this. I'll just run through it and just look at the visual instead of going through the nitty gritty on the hedging and arbitrage. But like I said, part of the other measurement is the portfolio. So depending upon how you define portfolio, meaning I'm only going to try trade energy as a classification. That could be you could define as a portfolio. You can do the same thing with the market indices and define that as a portfolio, and then run overall portfolio analysis against your sub portfolios, I guess you can call it. So you can do that with all the different hedging and arbitrage and all that fun stuff as well. This is another sophisticated thing a lot of the shops do. So again, you're going to start with your initial cash price and then your final price and calculate a P&L and all that fun stuff. Lost a lot of people already. It's that sophisticated. So again, it comes back to what I've already talked about, all the different types of diagrams. Here's where it gets interesting is the combined payoff. Okay. So if you do a long cash position trade, a put option, and lay in, I don't know, future a contract as well, you could throw in a combined payoff as well. And then you can get more sophisticated. And as I said, you can do the synthetic options as well, which is not a real option, but it's a combination between a put and a call. So in this case, we could go on your analysis here over a week. I can define over a day, 3 months, whatever. I mean, it's not a problem. And the other thing is you can do an analysis on a put and a call and seeing which ones works better for a particular instrument, in this case, gold. And then you can also start doing a time value analysis as well. Okay. This is another very important definition people do not factor in intrinsic value. Everyone looks at their statement on the broker, but when you have an open position, that's intrinsic value. You need to calculate that as well. And that's something a lot of people don't do because the intrinsic value can have a very big impact. And with the way the markets are going, or the governments are going, they want to tax that soon, even though it's not an actual trade. It's just as crazy the direction they want to go. The governments, and again, as I said, with the time decay, the time value. Again, I don't want to go too much into the detail because it just goes on and on and on. But you could do a put call option, 30-day different measurements as well. Okay, I'll show you some more sophisticated plots as well. Now, this one, these next two are very important to understand. This is the technical analysis I mentioned already. As you can see, most of your analysis is going to be doing what you're already doing. And the only time when you really want to use technical analysis is to time a trade. So the two basic ones that work the best is using an oscillator and a moving average. So if you're using a simple moving average, in this case on the price, you can just see on a 5-day on when to buy and when to sell. This is a classic, really basic combination. And people will soup it up with like 100 different screens and charts, and it looks like spaghetti code. But this is the most basic and most reliable is a moving average. So you can see here our SMA crosses. That's your sell signal right there. This is your buy signal. Simple, right here. Crosses, your buy. And then it's going to close the gap. That's your sell. That's the most basic and probably the most reliable way to trade. The other one that you want to measure is the oscillation on the price change using the different percentage on the price change. So this is similar as an RSI, relative strength indicator on the 20 and 80. People piling in, you want to get out when it hits 80, blah, 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 blah. But this is another basic type of way to analyze the market through charts. You have to see the speed of the valuation on the price. When you look at price action, the price starts to spike really fast. That's the speed of the trade. That's using some form of oscillator. And as I said, the oscillator is the measurement of how fast the price moves, both on the downside and the upside. And usually, how it classically works from the smart money side, they're going to go in here and just do some basic uh, entries. And as that price moves up, and people see that, and their algos see it, or their little bots or whatever, the price then starts to hit a certain threshold. What the smart money will do on the swing trade is they'll get out somewhere in here because they know the dumb money is going to pile in here, and the dumb money is only going to get kind of the opportunity on the last leg of that upswing, and then it starts to taper out as more and more people start to realize they came in too late, and it starts to decline. That's what we call chasing return. It's not the best way to trade. This is why you want to put what's
Yeah,
that?
we've all done it. We've all
Yeah,
done the chase, the late
yeah,
chase entry
you
at the
don't want
top.
to do that. I've done that for years. And what you're dealing with is just basic probability on saying, well, how long will this trade? How long will this trade keep moving up? Okay, and as more and more people get out, namely the smart money, they'll get out because they're that exits and the volume of trades coming in. That's their liquidity to get out. This is a typical penny stock. How they do it with the stock promoters, and it's no different with anything else. If it's forex, if it's stock, it's all the same. But you don't want to trade like that. You want to do it down here ideally, and the only way to do it is by using options and futures on that particular whatever the instrument is, and then get out somewhere around here and let the dumb money kind of push it as far as it can, but you don't care, you're out, and then let them see the collapse. And the probability of losing just goes up like immensely. You just don't want to trade like that. You want to be able to quantify and qualify your projection down here if there's an opportunity on the trade or not. And the only real proper way to do that is in the options space, using option chain data as I've kind of gone through this whole process. And if you can automate it, all the better. Okay, so we have here our put option, and we can analyze both the call and the put as well, as I said, blah, 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 blah. And you can see I'm at 40 pages now. I got two charts for technical. Everything else is fundamental, right? That's, again, what the smart money does, right? So here we can look at our futures P&L. Okay, here's our futures price. And then here you can see we're doing a combined payoff with a long cash in this case. And I've gone through the previous charts. I'm going to do a long cash, I'm going to do a long future, blah, 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 blah. We don't know, and combine it with the futures, but we could showcase that in this kind of report once it gets fairly sophisticated and very valid. And again, as I said, we can use on the option pricing all the different Greeks available to us that I've already talked about. Measure the different time to expire, what's our risk-free rate, blah, 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 what's our volatility. And the good thing with the Black-Scholes, you can forecast quite accurately the implied volatility, which is the volatility in the future. That's powerful. And then here we can measure, we're going to be in the money, at the money, and this is basically profit, break even, or your loss. And yeah, you can quantify that using these techniques. Okay, so here we're trying to show two things. Delta measure shows the option price is expected to move for every dollar in the change on the underlying price. Again, that's the futures price. And we can also calculate the ATM option, have deltas close to negative zero point 0.5, while the out of the money will have the lower delta. So that's ideally what we want to be able to measure profit potential. And along this way, you can chart all that as well. And that's something I've never seen before with the AI, because with the reasoning built in with the AI now, it just comes back with things I've never seen before. So you can measure your delta on the different types of on the underlying price along with your options price as well. And then again, this is where it gets very interesting. So in this case, we have our option price, okay, and then we can figure out what our deltas will be at what point, and that's all along the different futures price as well. That's how sophisticated this can get, and you can do that quite nicely with the AI. It's available to you today. Um, so again, this can be really good on all the things that I track, and this is what institutions are doing, or they will eventually get to this point once they figure out that yeah, AI can do a lot of the heavy lifting. So again, we can do the portfolio analysis using our hedge math, as I've shown before. Current price, what would happen if we add in a May future contract or a June contract being April, and apply the different options, different strike prices. And I've shown you the simulated options chain data, and that's just one option call or a put option with all the different scenarios on that option chain. Again, that what I have is simulated, but if I had the real thing, the predictions can be pretty well dead on because that's telling you what's going to happen in the market a week from now, a month from now, 3 months from now, and that's the sweet spot's definitely between the 1 month to 3 months. But the longer you go out, the higher your profit will be because that's how the options work. The farther out you're able to predict, your profit potential is higher. And again, you can compare all these different options as well. When to buy. Now, this is the AI talking to you right here. So for this scenario, that well, let's say key consideration for optimal strike price. Again, higher strike price provides protection but incurs a higher premium, and the lower strike price is cheaper but offers less protection. And that's what I'm saying. If you have a way to automate all this and to simulate this, you can get these exact results predicted from your whatever your AI is. And to be honest, this is pure data. It's all you're really looking at and have a set of rules to come up with these projections. That's the power of this whole process. Okay, so you can do a put option, as I said. I think this one's a call as well. So you can do a put option evaluation. Again, assuming you have today, and assuming here, this is important. If you had a 5% drop in the futures price or a 1% drop, and you also do on the flip side as well, on the 5% increase or a 1% increase at any point in time as well. And you can run all these different scenarios. And again, here you can see your intrinsic value as well, which a lot of people don't bother to look at. So again, we can get a key takeaway from this sort of thing as well. So on and on it goes. And then again, what happens if we have a low strike price? What happens if we have a high strike price? Blah, 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 blah. What would our end net P&L be? So you can run this all the time, even on open positions as well. If it's an open option or an open option set of positions or combined with the futures as well. So this is how sophisticated it gets pretty quickly once you get the understanding of it as well. So what we're looking for is we're trying to minimize our risk. That's the floor price, and be able to figure out what our optimal strike price will be. And are we going to arbitrage? Are we going to hedge and just have our head eventually explode, right? And then again, what kind of options combination we're going to use? We're going to do a bearish, we're going to do a neutral, or we're going to do whatever you want, and figure out a risk tolerance, and be able to calculate also with the volatility. All right, so we can do the call, we can do an option. I know blah 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 blah. I could go on and on and on, but you can see how sophisticated it gets, and that's the end of the report. Let me see if in the chat if there's any questions because we got our report. I haven't seen any questions. You guys got any questions so far? I know that was a mouthful. This is going to be a long presentation. So what I'm going to show you now is I've just shown you gold. As I said, I'm showing you true futures data, true cash data is cash price, futures price. The problem is being able to calculate um, the uh, the projected option stuff because, well, as I said earlier, the option chain data is very expensive. You can only get it really from the exchange if it's provided through your broker. And yeah, you can get it through interactive brokers, but you got to pay. You got to pay. Actually, I have to confirm it with interactive brokers, but I do know they have some option chain data, but you cannot access it from a systematic point of view. But yeah, as I said, you can get option chain data, but it's all manual. There's no API for it, as far as I know. I believe me, I looked. I even used DeepSeek to tell me does it exist, and said no, not publicly available. You have to pay. Any questions? Okay, so what I'll do is I'm going to move. Go ahead.
I have a question. Are you planning on running some of these strategies
Yeah, oh yeah,
with
it's going
some
to go
cash?
live. Absolutely. Yeah, and what I'm like I said, I'm using AI to generate the. I do everything I do is AI. I mean everything. This report was generated by AI. So yeah, I'll eventually go live with this and eventually throw some cash at it for futures and options. You're looking at the minimum because you also have to, if it's with futures, you have to factor in your margin requirement as well. That's where it gets expensive. So you have to have a certain amount in your account for the margin requirement, along with your actual future contract, and then if you're going to do a premium as well for the option call. So it can get expensive. Anything else so far?
You might consider Ninja for a lower cost or lower
Oh
margin
yeah, I
requirement.
didn't know that. I guess
Yeah, IB is a lot higher margin
okay.
requirement for futures.
Let me talk to that. Today or yesterday, Kraken announced Kraken, the crypto market, crypto exchange. Just so you know, I think I told you, Jonathan, that Kraken took over Ninja Trader. Okay, so what they announced today is
Yeah,
that they now are enabling stocks on Kraken and eventually ETF using Ninja, and they're going to do a massive IPO in the fall. So the one exchange, quote unquote, broker to watch for now is Kraken. Um, and
mm.
if that's the case, then yeah, I'll look at Ninja as well. I'm sure that they have some pretty good APIs, so I may look into that. I'm a current client of Kraken, so I do love interact. Well, I should say I love. I'm very questionable on interactive brokers, but I think Kraken's going to change the market in the fall. And look for that story on Kraken with a stock and ETF edition. They're going to become a legitimate stock broker.
I think a strategy that just switches to the high momentum coins would be interesting. Do you have anything like that in
Um,
mind?
like I said, I'm trading through the futures market. The only three coins available are Ethereum, Bitcoin, and I just confirmed they've added a couple of weeks ago, and it's live now, Solana. So they're going to add, I believe,
Yeah, I
XRP.
saw CME has the
Yeah, yeah,
micro
yeah.
Solana. Yeah.
So that's going to be the exciting thing. But when I haven't been able to yet generate reports on those three coins. But if you look at TradingView, the futures contract on the CME is very spotty. It's. I don't see the point in trading the futures market with those coins. I'd rather just go through a large exchange like a Kraken or a Coinbase for crypto. But I think in the
Yeah.
fall
Okay.
it's going to get a lot more sophisticated, and hopefully crypto will start to build some volume uh, from the institutions. And as I always say, you should ask questions about BlackRock on the impact on that. Just drop it a hint here. Let me put it this way: the way things are going with what BlackRock has control over, I don't think I'd want to trade Bitcoin and Ethereum with BlackRock involved. I'll just leave it at that.
Mhm.
We could talk privately about it. Because if that guy, if I'd be very sued to the hilt if I talked about it publicly. Um, okay.
Any modeling you've done to try to estimate profit potential for some of the
Yeah,
ARB
yeah, that's the whole point of this. But
strategies?
again, this is just early days from what I'm doing because right now, as I said earlier, you can develop with AI whatever language you want, be able to develop specific custom pricing engines for a trading opportunity for particular assets. So we're going to get to that point where You go through this sort of combination of trade opportunities with options and futures, and there will be the day where you'll be able to take that data, feed it back into an AI, and come back with a custom pricing engine of some kind for that strategy, and have it run against your broker. I believe we're going to come to that point. I'll be testing that. So to answer your question, the only thing I can run this with the analysis, with the automation. The thing is, the next step is to build out the pricing. I mean, when I say pricing, that's the order execution engine. But I think you'll be able to build out specific custom uh, order engines for specific instruments based and build in the custom trading logic for whatever strategy you see with those opportunities. Am I making sense what I'm saying here?
Yeah, it's an analysis engine so far, and the trading aspect
Exactly.
comes a little
But
bit
what I'm
later.
saying is you'll be coming to a point where you'll be able to build out a custom pricing engine to do your automated orders specific for that strategy, for that instrument. Make sense? Yeah, I think we're like
Yep.
like AI is getting that sophisticated now. I'm blown away with specifically DeepSeek on its capabilities. Okay, so I am going to bring out a special chart for you, Jonathan. Um, so what we're going to look at is the ES. I'm just going to look at the visuals. I know you just came in kind of later, so I'll kind of run through it. Just bringing it up. So let me bring up the share screen. Oh, my computer once again. Okay, I am looking for my share screen here. Bear with me for a minute. I do, yeah. Zoom is going crazy on me. Okay, here we go. I'm going to share my.
You doing the fifty
How
dollar
you
a point
mean?
version?
Oh, you mean the plan that I have with Share or with Zoom?
Yeah, ES is $50 a point. You're not doing the
I can't
micro,
remember. I think I'm the
which is
work base level or whatever. You guys can see my screen now, right? Okay, cool.
yeah, Word.
So here's the report for the ES. So this is kind of specific. So what's happening in the markets right now? Because I've got other scripts I've run where they will measure very simply ETF and single stock in the US. So what's been happening is there's been a massive, I don't know, call it collapse, crash with the equities market. So what's been happening is I've been like, oh, it's going to bottom before all this tariff nonsense. Um, I thought it was going to start to bottom and start to move up. And with that set of scripts do, they measure what sectors to be in using ETF data and single stock. So can get pretty sophisticated. So I think we're kind of back on the bounce now for the stock market, as long as Trump keeps his mouth shut and China doesn't do anything as well to jitter the markets. Hopefully, things will start to normalize as well. So, as I said, I'm just going to give you the highlights here. So, again, this is the important part. When it comes to trading, institutions are going to want to look for low volatility. As I said, we have right now 18% over annual basis on the stock market, with the ES being the S&P 500. That's pretty high. Gold, I believe I had at 12%, so that's pretty high as well. So the volatility's gone up a lot. So it's very hard to measure when the timing is for dipping into the markets, because if the volatility is at 18%, you could trade tomorrow and lose tomorrow because of uh, unpredictable volatility. But again, what I've shown in the prior, you can calculate that using the futures market and get your implied volatility using the Black Scholes. Okay, so here again, you can kind of get your volatility current, and then you can also get, let me just see here. Yeah, your implied volatility if you were to do a call or put option, and this is your implied volatility. Again, this is simulated Again, it could be wrong. I have to verify everything, but again, it's not investment advice neither, as I forewarned at the beginning. But just to give you an idea, you can use the implied volatility on where things will go using either the ES or the NASDAQ futures and options as well. That's the nice thing about this. So right here, we're using ARIMA. And as I said before, it's kind of trying to forecast where it's going to go. Well, what does this mean in red? ARIMA generally can be pretty decent. The gold is going down, and that would happen if the stock markets goes up. There's that indirect relationship, and sometimes it's broken where both go up and both go down. It shouldn't work that way. Here, we don't know the direction of the market because of the crazy volatility. That's the problem. So again, I'm not going to go into the math and all that. I just want to show you again, this is what I'm here showing you is the option chain of a simulated strike price and what would be in the money, out of the money, and trying to figure out what would the moneyness be of profit potential and what would be the best strike price to get maximum profit. So that's the nice thing about this. Okay, and then as shown earlier, we have the detailed option chain at this price here, and we can get both the measurement on the call and put side, and also be able to apply the Greek analysis for either option, sorry, the put side or the call side. So we can kind of do that. Once I get the real option chain data, believe me, the value of this will multiply by 10 times or 100 times because um, as I said, to get access to that, it's very, very expensive. Again, we can use the different Greek analysis as part of that on the option chain as well. So I kind of covered that pretty good. This is the real nitty gritty of it all. There's a couple of different ones I've kind of gone over. The put call parity. See the tightness here between the put and the call? It's pretty tight between the two. So that means as long as it's tight, it's the market has an equilibrium, which is good because there's both a demand and a supply side. It's pretty close for that measurement. And again, this is the sort of thing that the HFT shops and the hedge funds are looking at using option chain data to get this measurement. Because once it's out of whack, that's where you have that classic market opportunity. You'll see that in oil with the call put parity as well. So that's really important. And then you can also use this risk frontier as well and find your optimal portfolio as well. That's why you want to use this stuff as best as you can. Once this has been validated as well. And again, we go through all of the fancy schmancy different option strategies. Again, the long call option, you can measure it by bullish, we can do the bearish, we can do the neutral, blah, blah, blah. We've already gone through this. So I said this is going to be available on YouTube as well. So we get all that fun stuff. We get our neutral, a batch of the fish as well. It's very sophisticated what's being built out here. And as I said, we can get into the really sophisticated ones with the iron condor and the butterfly as well. I just got to make it look better and validate it as well. This I'm not sure, but if you went through some of the other contracts or the other type of data, they look really weird. And I think a lot of it has to do with it's not enough volume in the price to properly present the payoff diagram. Okay, so again, what we want to do here is to minimize our risk and maximize our profit using the options. That's basically what we're trying to do here. So we set a floor price, measuring our strike price when they go in as the break even, and then use the options side for our maximum potential on the hopefully unlimited profit. That would be the ideal. And this is the type of returns that can kind of change your life once you get the data better and get better insights. So again, the screwed up looking plots. This will get better, or I might just take them all out if I can't get it to that point. So I'll screw all that. But you can see in a very insightful way both the data and the plots. The big one to look for is what's the call put parity? Is it out of whack? And what you'll see with the oil in the next one. That's why I'm showing you that. This right here is the measurement. And again, this could be wrong. but on a call versus put, and what's happening on the strength of is it more of a call or is it more of a put on the option side on to measure your, your future, um, is it going to go up or is it going to go down using the call and put? And as I say, you can go out a couple of days, you go out a month, you could go out 3 months. Um, and that's because all these institutions are putting positions on using these different time frames for the options across all the way up to 3 months. It can go out to a full year, but it pretty well thins out after 3 months. So 1 month to 3 months is your accurate way of saying yes. Uh, you can,
So the micro ES has a call put volume ratio of 0.97 right now.
yeah,
So
yeah.
it's
Well,
pretty
that's
neutral,
because,
I
as I
guess.
said, because the put call parity is kind of in line. You'll see the difference with the oil when I show you that. Okay. So again, you want to be in this zone on all different options you put on and the futures as well, measuring your strike and all that fun stuff. So I think that's kind of, you can play around with the hedging and the arbitrage as well. Is there an arbitrage opportunity and blah 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 blah. The Nasdaq's totally different from the S&P as well. I just want to show you the one market index. Let me just see if there's anything else I can show you. I don't think so. But generally in detail, so this is the interesting one where you can get a combination between your future and your what type of option you want as well. If it's a call or a put as well. And as I said, as I've shown you, you can also go into the nitty gritty on the number of contracts you need depending upon the size of your portfolio. But the point is that you're able to measure um, the key is quantify and qualify your forecast. Because if you're able to do that, you're no longer guessing using just some technical analysis indicator or chart and then complicate it by adding more technical analysis. like I just don't want to insult the dumb money crowd, but this is what the smart money does. They use the dumb money to get out of the trades using that extra liquidity once the dumb money figures out, yeah, there's a trade here, and then they just chase the return wherever it goes after that. Anyways, I think I'm done with this one. And again, you can see the technical, if you were wanting to do this trade, and this is what's happened in the last few days. You can see the closing prices moved up. Right here is your entry when to go in. Now, here's the problem. This is just from the SMA, the simple moving average. You can see here on the selling on the crosses here on the selling, there's been a tiny amount of buy opportunities just using this on the price and the SMA cross, so a 5 day. You can see right here, here's a sell, but look what's happening. These two are about to cross the 5 day SMA and the current price. So once this orange, the 5 day SMA, once it crosses your price, guess what? You're now going to be selling. So you didn't have much of a opportunity to buy into the market. So this right here, just using this one little indicator, sort of when to stay out of the market, unless you like shorting and catching falling knives, as they call it, or just kind of take advantage of the opportunity right here on that cross on the SMA, along with the selling. If unless the price moves up and the 5 day, as it lags 5 days, it'll catch up. But as long as if this continues to move up, then we won't have to worry about that close. You can see how narrow that trading opportunity is in the S&P. I don't know what it would be like in the Nasdaq. And again, you can see here if you already typically use um, the RSI or an oscillator, you can see right here. Yes, it did tank over the last number of days, but look at what's happening. Because it's been holding out, the pressure of the RSI equivalent just moves up really fast. So that's why you're getting these kind of pops. But you can see it's going to start to decline, and that's all dependent upon what these two do, the SMA and the price. And that's all you need to know about technical analysis. That's it. Everything else, I'm not saying it's useless, but that's the basics of technical analysis. And everything else is just quantifying and qualifying what happens in the futures and the options because that's what impacts the spot market on the futures market of both the S&P and Nasdaq and the futures and option space, and it's a spot market that will catch up to that. That's why it's more.
Which
These are
time frames are you
these are
talking about
daily,
on
so it's
your
more
chart?
um, investing. It's not day
Okay,
trading. And what I'm
yeah.
telling you,
So kind of a
yeah,
low
yeah,
frequency
yeah.
trading.
But go
All
ahead.
right.
But what I'm saying is, go ahead, go ahead.
LFT,
Well,
LFT, right? Low frequency
it
trade.
depends how sophisticated you want to go. Um, I'll show you in the oil report, and you'll know if you have the sophistication of the hardware and the account, and you have the right broker that has the low, virtually no commissions. Yeah, you would want to go high frequency, and I'll show you that. I'll show you the opportunity there. And I think this tells you when you have the equilibrium in the call and put, that tells you it's it's an equilibrium market, and that's ideal for most markets because it's more stable in the price, if you know what I mean. And the extremes are not so extreme. The volatility is lower as well. But once you get an exogenous event when or or I call him, as I said, Trump opens his mouth or China says something that impacts the market, which is the external or exogenous event, it's going to do crazy things to the markets, is what you've been seeing, like these crazy drops. And now it gets more extreme when you start to look at the DXY or the Treasury, and I can do that here and be able to see exactly what's going on in both DXY or the dollar index, along with the different durations of the treasury. And as I said earlier, that's what you call the basis risk. And you're able to measure it using these kind of reports. And right now, that's the key. You can go into the news, your Bloomberg, your CNBC, and right now they're talking about, yes, there is a basis risk when it comes to treasury. And once that risk goes up, it's kind of game over for the U.S. I hate to tell you, and that's why you're seeing the dollar tank the way it is. So the only thing that's going to keep the dollar stable is what happens in the markets. So that's why I think you're going to start to see a Mr. Quiet Trump over the next while, because whatever he says on the downside, it's just going to tank everything. And where it's really going to hurt the U.S., the economy, and specifically the dollar, it's these type of events. But using these kind of reports, you're able to see what's happening in the market because I'll run these every day, if that makes sense. Um,
Yeah,
and again,
cool.
you can see what's happening, what the traders are doing, and you can quantify, qualify, which is the key as well. Um, I would show you the treasury, but it just looks pretty crazy.
For your daily
I
runtime,
can
is
run
it
it
end of
whenever I
day?
want. These were generated at 5:30 today. It doesn't really affect anything because it's
Yeah.
daily data, right? Like you could see it if over, let's say, 3 to 5 days, yes. But if I ran this midday, that price change, you won't see that impact unless the price just collapses. But I won't be able to capture it until the end of the day because that's when that price will be available when it's marked for the trade for that day. Usually it's going to be after it closes. So I won't, I can do other sophisticated things intraday, but this is really more for long-term investing. I mean, I could kind of go sophisticated as well for intraday, but again, intraday just increases the risk on your trades as well. And with that comes your commission. And if you're losing more, those commission rates are going to kill you. That's why I prefer to do.
You describe
Oh,
the
these are
red
the
dash
different
lines on your ES
delta
chart.
calculations at the different underlying price against the options price. So these are generated over a period of time on the delta as well. So that's using a delta on one of the Greek analysis as well. So this I got to improve upon, but these are the different deltas at the different future prices. But you can see here that this is way off. I wouldn't look at this at all. I just want to show you like the potential of these kind of reports. That's why I'm doing this, right? So it goes on and on and on about what I talked about earlier. Okay, so as I said, I just want to show you the charts. But let me this is the reason why I'm showing you the oil. Okay, so with the oil, CL, there's something I want to show you here because you're asking about intraday opportunities. So when you look at these kind of reports, you can figure out which instruments are good to trade in based upon is there volume, is there liquidity. So for instance, right now, corn is doing well because it's a corn is a uncorrelated asset, meaning it's not really affected by what goes on in the stock market, is not affected by what's happening in treasury or currency like the dollar. That's why I think the volume's fairly high on that one. But let me just show you the charts here on the Nasdaq. Okay, or sorry, the CL.
People
Sorry, what
like
was
to
that?
eat.
Yes, yes,
It's high
and profit
demand.
potential. I can pull up the bar chart. I don't know if you know about the most active future contracts. I can show you that in a minute. With a CL, we know about how the oil price is pretty well crashed. And again, you can see here using the ARIMA model, that little red squiggle, this tells you the direction what it thinks it's going to go on the futures price, which means it's going to slightly decline, but it'll stay stable. You saw how it went up quite a bit with, no, actually, it went down with gold.
And that's based on what
It's,
are the main parameters that
well, the
the model uses
parameters
to estimate.
are, okay, so it's a 5 day prediction. So we feed it. I can't remember. I have to look at the code and get back to you on that.
So it's predicting like sideways
Not
action
five
for
days,
five
but I'd
days.
say the
That's what
next
you're saying
little few
on the oil.
days. Sometimes it's not accurate, but it's pretty good. That's why I use this
Yeah.
ARIMA. It's pretty popular to forecast price direction. But you can go pretty far out, but I only keep it maximum 2 to 3 days.
I know OPEC increased
Yes,
their
they're trying to
output. That's
stable.
probably the
Yeah,
main
yeah, they're trying to
reason for
stabilize
the
the
price
price.
reduction, right?
Exactly. Yeah, that's probably how to explain it. But again, what I want to show you here is you can see the number of puts versus the calls on a simulated option data. So this is not 100% accurate, but you can definitely see there's more puts, there's more selling demand in the options market. So that's kind of not accurate. And you can see also in more detail, but this is again simulated on the options chain. The options chain data is the key. You can get access to it by eyeballing it in, let's say, a trader workstation and interactive brokers, but you cannot access it through an API. The exchanges are protecting that. You have to pay for that. And as I keep saying, that's very, very expensive. This is what I want to show you in this particular asset, oil. When I talked about the put and call parity, I verified this. This is real. Um, so right here, if this is real, I talked about the equilibrium between gold, which is a little off, and it's pretty good with the S&P. You can see that this is vastly different. And this is where I think a lot of the HFT shops are playing in because this is an easy profit for them. And that if this is true, this is why this is happening, why the price is coming down, because there's probably a ton of high frequency shops, hedge funds creating this. I just read a report on oil. They were putting on a lot of shorts about a month ago, and a lot of hedge funds got killed. I put up an article on Man Group lost a lot of money because they got it wrong on the shorting. Even Renaissance Technologies lost quite a lot of money, just as bad as what when they lost money in 2020. I've put up articles on that on my blog and why it caused. Because what they did was they put on all this extra leverage, thinking everything's going to be all hunky dory. It went against them, and they got blown out. Um, so the problem is I think with something like a Rentec, um, they're bringing in a lot of juniors and they're letting the juniors run the shop. They're not using these techniques to protect their profit. Um, and their forecasting is way off because they're not using these techniques. That's what I'm starting to think now. But right now, oil is a shorting opportunity is right there in front of you. And I think this is free money if you knew about this. And that it's called
Can you describe the
well, like I
opportunity on
said, you can
oil in
see it
more
in the
detail?
price, right? Yeah, and the other
Yeah,
thing
it's
is you can
low.
see the selling pressure that's happening with the puts being more puts are put on the price in the options market. Okay, simulate, but I can kind of confirm it's kind of there. I can't say yes or no. So that's another indicator. But the real one is this call put. Like this is the key of it all. This is the equilibrium of basic supply and demand in the options, sorry, in the futures market for oil. My theory is that HFT and high frequency trading shops specifically see this as an opportunity and they're just putting in tons of shorts. And no matter what OPEC does, it's not going to change because there's so much selling pressure courtesy of a lot of the HFT shops. I think that's what's going on with this equilibrium between the call and the puts, if that makes sense. I'm just trying to hint at here that this should be accurate. I'm not saying it is or it isn't. That's why I'm trying to bring in experienced, profitable options traders to take a look at this stuff because that's what I'm after. Because I'm throwing in the techniques that they look at, but I need to find these option traders to verify and validate these kind of reports. And the other thing is that when you look at these type of bullish strategies in the options space, are they like what kind of strategies are they putting on? Are they putting on a long call, short put, long put, whatever? But you can see kind of the opportunities there and all the different types of strategies. So that's why I include it. And when they look weird, um, they probably are not valid in terms of the data, if that makes sense. Like this one, iron iron condor. That's a fairly sophisticated strategy, and same with the butterflies as well. I think that's it. And then you throw in the hedging, the arbitrage as well. But I do think that this oil right now, from what I'm seeing, and I've generated this since Friday, that might be a valid theory that I'm thinking could be real. But um, here's the thing, just so you know, I have the ability now of all these different contracts to look at. So as I said, I can look at different types of commodities. I can look at agriculture as part of those commodities. I can also look at gold, silver, copper, platinum, or palladium, one of those two. I can also look at the different types of agriculture. I can look at the meats. So one of the traders I talked to in my Facebook group that you know of, Jonathan, he only trades meats and he's profitable. And the point here is why you want to trade like this. Huh?
That's the futures guy. The guy that goes by the name Futures,
Yeah.
right? You said he trades
Yeah.
meats.
I talked to him on Saturday and he only trades meats. And he's smart because he's an experienced futures guy. He will not touch.
Yeah, they have some nice very trending patterns on those charts for
Yeah.
some of the meats, like
But there's a reason why he only trades
cattle,
that
I
is
think.
because it's an uncorrelated asset class, we'll call it, meaning it's not related. What's that?
And very trending.
Yes,
And it has
yes,
nice smooth
yes.
trends
I
also.
did see lumber's a good one right now. I think it's live cattle is the one he's probably making most trades on. So because it's not related, so go ahead.
Yeah, LE.
LE, that's it. Yep, you got
LE.
it.
So like cattle, it has
Yeah.
some
Yeah,
nice
exactly.
charts. You like
And
the
for a
charts when
while,
you see it.
coffee was going gangbusters, cocoa was going gangbusters. But my point here is when it comes to trading, most people will go crypto, Forex, and retail Forex, not futures and options currency. And then they'll just trade their stock and ETF. That's how they see trading. But the pros are going to be focusing more on the futures because they have, as I said, I can track right now over 40 assets, a lot of different duration on treasury, as I said, all the different agriculture. And because the agriculture, let's say meat or livestock, those are not related around to the performance of the stock market. It's not related around what happens in the currency market or what happens in the treasury market. That's the beauty of trading both options and futures among the entire universe of what you can trade coming out of the US, out of Chicago, out of CME. That's the beauty of it. So whatever happens in stock market, you don't care. You can still find return and gains in, as I said, agricultural and um, livestock, because there's a demand for it no matter what happens in the economy. And way I see right now, I think HO is hogs. Oh yeah, let's take a look at LE as an example. So this is live cattle.
Also, the 60, the given to look at CME,
Yes,
the euro
I
dollar.
can't track that right now. I don't have access to the cash market. I have to go into the retail forex to get the cash market. Once I do that, that's the same with a lot of the crypto as well. But you can see here, this is now right here. Look at that volatility, right? That's pretty low. Oh, I'm sorry. I'm sorry.
Share
I
the
got to
screen.
share. Oh, you can't see my screen. I got a stop share. Can you see it? No? Hold on here.
No.
Let me do this over again. Okay. So there I am. Okay. Let's do a share screen again. Full screen. Okay. Please tell me you can see it now. You can see it?
Yeah.
Yes. This is a report.
There's a Word document.
Okay. So this one right here is which one's that? That's the ES, I believe. Uh, yeah, sorry, this is the oil. So that's at 25.5% annualized volatility. That's pretty high. Okay. I wouldn't want to trade that. Okay. Meanwhile, if I go into the um, LE market, which is the live cattle, you can see the volatility is very low, 10%. I mean, this is like free money basically with what you're about to see. So
That's
yeah,
volatility over a 1 year
20 day,
period,
one
right?
month, 20 working days.
20.
So
Okay.
you can see here with the price, it's been pretty nice since September 2024. So it's kind of volatile, but it had a nice trend up. Now, will it continue to move up? I can't say, but keep trading that and being uncorrelated to the stock market, uncorrelated to currency, unrelated to treasury. Yeah, I don't think this will get impacted. Okay. So you can see a really nice return. And then you can go through all this regular stuff. But for the volatility at 10% over the last month, this is a pretty good thing to trade. You can only get access to it if you're trading futures and options. And I think that's why this guy's getting a pretty decent return. I won't say it's like free money, but it's the least it has the least risk for sure. Now I'm going to bring up a browser here. I want to show you something as well. I mentioned this earlier. Um, so if I go over to this thing called Google, Bing, whatever, and I look in most, I don't know if people know this, but there's something called most active futures. This is from bar chart. This is pretty cool. They've kind of restricted this, but you could calculate what are the most active futures right now. This is both on the short and long. It's just all based off pure volume. My point. What's that?
I'll bet it's
It is during the
I bet
working hours.
ES
You
is
can
number
see
one
the
volume.
Nasdaq. This right now 9:12 p.m. Eastern. So you're going to get the overnight futures contract with micro for Nasdaq. So this is probably right now Asia trading live sugar. If you looked at during the day U.S. time, Eastern Standard Time, you'll see in there corn as one of you see the Treasury and the different contracts for the Nasdaq and S&P. and oil is up there.
So Nasdaq sugar,
Yeah.
Nasdaq
But
sugar
my point
ES, and
is,
10-year. Okay.
for that, if you were to look at during the day, corn would be up there. And this is the top 10 by volume. And that tells you people are trading corn
Yeah.
because it's profitable. Yeah. And it has nothing to do with it's uncorrelated. And that's what people will want once they understand the term uncorrelated when things get back. And I think they will. It's just a matter of time. You can see here, Japanese yen's up there. That one's doing nice. It's another nice trade. I can't show you the chart, but let me see if I can pull up my trading view. I just found out that symbol called 6J. Let's see if I can. Yeah, that's the
6J, that's the
yeah. So
Japanese
so you know,
yen
everybody, I've
currency
got
at
nothing to do with
CME.
this. You like your trading view, 80% off right now for Easter, twice a year, Black Friday and Easter, and that's a pretty good discount. Okay, anyways, let's see here. I'm going to look for 6J right here. So that's the Japanese yen. In the futures, is that this one I got a notification that now hedge funds are moving into this. This is now the safety trade, the carry trade. This is starting to come back now. Let me see if I do let's say a 5-day chart. Boom. It's kind of gone flat, but it's starting to move up. So if you look at 1 month return 2.72, not a lot, but considering the market way it's been, um, that's pretty good. I don't know this drop, but as a swing trade is trending up. So that's doing okay. Europe, the euro's kind of moving along pretty good. Um, but right now, the best ones are the corn. Do you know what this? Okay, let me show you Bitcoin in the futures market, just so people understand what we're dealing with here. So this is the CME as the provider of the data. If I go, let's say 6 month, that's looking pretty good in terms of volume. Okay. If I do a 5-day, actually it's looking okay. If I do a 1-day, last time I looked at this, it was pretty spotty. Let me just check on the Ethereum as well. So Ethereum futures, you might start to see it where it gets kind of spotty. So let's do a 5-day. Yeah, it looks okay. And as I said, now you could do Solana as well in the futures market on the CME. Okay. This is fairly new. Yeah. I'm just looking at
It's
Solana
MS,
full
I think it's
price.
MSOL or
Just
MSL.
trying to see if I can see. This should be pretty volatile, this pricing, but it's pretty good. Just so you know, if I look at the super chart, this is really cool that no other platform gives you this. Um, so let's say we're dealing with the futures market. See all the gaps here, right? So that's on a 4 hour time frame. If I go down to 1 hour, you'll see how spotty it is. It's not a solid line. If I was to do the same with Bitcoin as well, it's the same problem. Okay, it's not so bad, but you see there's more gaps. You don't want to trade when there's gaps. Um, and if I was to do an ES contract, what you want to see, you can see there's much fewer gaps. You'll get the odd one, but that's at 1 hour. Now, let me show you just something really cool. So you can see here with this with trading view, you can go down right down a tick. You go down 1 second, right? You can't do that with any other platform that I know of. So that's what I'm saying. If you want to take advantage of knowing what has volume, this right here is worth the money because I don't know any other platform that will give you using the CME E-mini futures on 1 second. And you can go even farther down, 1,000 ticks, 1 tick. You got to pay extra for that. It's not very expensive. And you could trade off it too. Sorry, go ahead. Is a question? Oh, oh, okay.
That was just me. That was just me
So I
doing
just
an
want to tell
order.
you that with TradingView, you can see right down a not sub-second, but second. So if I start to look at something like Bitcoin again on the sub-second, okay, this is why I don't think crypto is not there yet for futures. Okay, so if I change this over to Bitcoin, the volume, and it'll show you the 1 second, how do you trade that? You know what I'm saying? You can't do a lot with it. But if you go to crypto,
Yeah.
okay, and look at something like Coinbase, okay, on the second, you can see it's much nicer. There's no gaps because the volume's there to support Bitcoin on Coinbase in the retail market. You can also do the same thing with Binance as well. And again, this is 1 second. There's virtually no gaps. So if I was to show you Bitcoin, I guess, yeah, I guess they got Binance. Sorry about that. Bitcoin USD. No, I'd have to do Tether. Let me see. Yeah, so I can show you Bitcoin and Tether. You can still, on 1 second, you can still get Bitcoin uh, spot data at 1 second. That's pretty impressive. And then you can go through which exchange, crypto exchange, to see
Yep.
where the volume's at. You can look at like weird coins like the near or I don't know something like that. That's less traded. Like near auction. Actually, that's pretty good. What's a more less traded coin as an example? Anybody? Which one? Oh
Fartcoin.
yeah, Fartcoin. Fartcoin
Your
to the
favorite.
rescue. Okay, so now we're looking at you
They
see
had some
one
pretty good moves
second. Okay,
lately.
not so much. Let's take a look at a 3 month chart. Yeah, now you're talking. 20 to 91, 4 time return. Pretty good. Fartcoin. I would say
Yeah.
Fartcoin to the rescue. It's a joke coin, but this is how Doge started. This could go Fartcoin to the yeah. Wait, to get the return.
Yeah.
Okay, let's see
400%
if we
return.
do Bitcoin. Okay, so what's the difference? Negative 12.
I
Yeah,
didn't
but
buy
look at the
back my
difference between
Bitcoin. After I
Fartcoin and
dumped my Bitcoin, I didn't buy it back.
it's a, it's a joke, but
I know.
like,
That's what I should have bought.
look at this up 221% since March 25. That's crazy. But this is how millionaires are made with Doge. Fartcoin's going to move, dude. The joke coins are always up, but this has been a shocker. I'm going to go all in with Fartcoin. The problem is that there's no Fartcoin on Kraken. So what to do? What to do? Right? But these are only exchanges that have it. Oh,
It
actually,
is.
there's
I thought it
Fartcoin
was
on
on
Tether.
Kraken.
Yeah, it is in
I,
Tether.
I think it's on Kraken.
Right? They don't have it U.S. dollar yet, but yeah, I can do Fart. So I just buy my Tether and trade my Fartcoin all in to the moon, to the moon. I think that thing's going to do really well. I'm going to put. I should put more money on that. I think that's going to be like another big Dogecoin. After 2 hours, that's a reward you get for watching me blab for 2 hours. For a coin to the rescue, and you just remember where you heard it from. Okay.
I mean, if you compare it to all
Yeah.
the
I
others,
mean, give me
it's
another
like
coin that's been
huge
performing
return.
in the last month. Nothing. I mean, Doge had a moment. I mean, I think right here. There you go, Doge, dancing Doge. But right here. But Doge is underperforming. I'm sorry. Let me just do. Yeah, let me add in Fartcoin here. It's a joke, but if you want to make real money, right? Look at that. That's crazy, right?
So Singapore Open just happened, and they ran up the micro ES. They ran it up to yesterday's close price,
Yeah,
and it poked above it, and then it just kind of bleeds
yeah.
down.
Well,
So I shorted
shorts I'm
right
not a
there, and
big
I put a
fan
tight
of, but
stop.
and leverage ETFs is another one. I get killed on leverage ETFs all the time. But I think this is like from that simple moving average I showed you with a S&P. I think it's going to be a short-lived rally. Like give it a day or two, and then it'll fizz out, and it'll just stay flat. And then gold will continue to move up, unless, as I said, there's like some unpredictable event between China and Trump. So I don't know. Anyways, that's all I got to present. I mean, you guys got any questions or comments at all? I mean, I could be on here for months on end. Any of you guys got questions? Let me. I'm gonna kill the screen here.
Are
Um,
you gonna buy? Are you gonna buy
I'm gonna
some of
be
this
honest with
purple
you.
asset,
I am very
the purple
interested in
gas?
Fartcoin. I should have done it a month ago. I really think that that's gonna be like when you look at what happened with around when was it in 16, there were some challenge markets, but Bitcoin moved. And also, what moved a lot was the Doge. And we're in the same conditions now. And there's always this weird coin that will just do crazy moves. And I really think Fartcoin's the one that's going to move a lot. I mean, it's already up. What was it, 100, 200% in the last couple of weeks? And I think the smart people will pick up on that. And yeah, it might be a joke,
Yep.
but if you want to make money, I'm not saying it will be a for sure thing, but Farcoin, I don't know. It's just there's something bizarre about it. I'm getting more convinced on it. Yeah, I might just put all my little crypto amount on it and see what happens. If I can double, triple it, I'll gladly take it. You know?
I've been just scalping the micro ES 5
Okay,
lot
let me check that.
repeatedly since the
The
patterns are familiar.
is that the
I'm using a 2 minute chart right now.
MES? Okay. Okay, hang on here.
MES 2 minute.
So you're on a 2 minute chart? Okay.
Yeah,
Okay.
it makes the
Okay.
linear
Let me just get
regression
rid of
curve
that. What
smooth
what kind of indicators
for
are
a
you
trend
using right now?
indicator.
Okay.
Linear regression curve. It's like a
So
best
in
fit curve.
here, if I do specifically linear, yeah, okay, let's see what this says. That's what I love
LRC, linear
about
regression curve. Yeah.
uh, oh yeah,
Yeah,
but
they have
10
every
times
indicator known
over.
to man, I think.
I
And
mean, I
trading
gotta
view.
tell you, this is awesome. Let's see, linear. This one, I that
Share screen.
let me think here. Linear regression channel. There we go. So right here, buy entry. Yeah, right there. And the thing is, you can look at the source code too. Is it?
Yeah, I think it's a 25 period for the parameter.
Yeah. Let me just see here.
So it's an average of
Okay.
25 bars.
So what's its standard deviation? You said 25?
That's how I'm using it. Let me see.
I
I don't
think
have that
that
parameter on mine. I just have
the
number of
length is
bars,
25.
25.
That's a pretty good
Yep.
indicator.
Yeah, it's like trying to draw a best fit line, except it
Yeah.
curves, according to that look back period of 25 bars. And if you try it on a 1 minute or a 30 second, it's also good. So look at it on
Yeah.
multiple time frames. But I've just been using the 25 bars back. If you study it intensely, you'll see that it has a lot of useful patterns that it brings out, especially the slope change when it goes from a negative to a positive slope. That's
Well, we can look at
oftentimes a real turn in the
the
market.
15-second. Oh, I'm sorry. Sorry about that.
Can you share your screen?
Sometimes I could be doing stuff and I wouldn't even know.
So the MES is down a few points now on the
Okay,
short,
you can see my
so it's in
screen.
the money, 60 something bucks.
Okay, so this is 15-second right now what you're looking at.
Yeah.
Okay, so yeah, MES.
What market is this?
Yeah,
MES. Okay. So yeah, you see the little
yeah,
pink at the top. So yeah, that was the Singapore Open. They ran it up to that top, and that
got it.
5441 at the top there is the yesterday's close, or really today's close, right? So they
Oh,
ran it up
this
to
is,
the close, and now it's coming back down. And I shorted it right at the close,
but
so
just
it's
so
now in the money by 45 bucks
so
on
right
a
now
five lot.
I'm on the 15-second right now. So this is kind of like a channel indicator. What's
Yep.
the lowest you can go? 1 minute?
I'm using a 2 minute,
Oh,
but
you can go
yeah,
that
I use
low.
2 minute, 1 minute,
So
30
here you can go
second,
like five
sometimes
second.
15 second. Yeah.
Yeah, you can see how sensitive it's moving pretty good. That's all you're using exclusively?
Um, there's another parameter. That's the main
Okay.
one. I use the VWAP also, intraday VWAP,
Intro weight
volume weighted average price.
VWAP. Okay. You said an
Resets itself
ARR,
each day,
remember?
at the beginning of the day.
Here we go. Intraday MTF. Multi-day rulings. Probably Viper. Maybe it's probably something like this. Okay. This looks like it's only live on during the trading day. I-
What do you think of this market right now? Are they gonna
Um,
rally or are they gonna fade off?
Depends upon what's on the news. Coming out of Asia. Let me just check. That's really
Yeah.
drives it. But I mean, what they were saying about Sunday night. Oh, sorry. What they were saying about Sunday night is they were expecting a big bounce. Didn't happen. Okay, that might have an
Oh,
impact.
China
Let
open
me
in
just
30
pull up.
seconds. Yeah.
Yeah,
I got my tight stop at a break even almost right now. They'll
yeah,
probably rally
yeah.
a
It's
small
tough. You have to
rally here
watch
for
the
the
news
open, I
for all
guess.
this fun stuff. Oh, there you go. It's starting to cool off.
I got
That's
Bloomberg
on the
on the
five
iPad
second.
here.
You can see that, right? It's a good indicator. But that's kind of too
Yeah.
sensitive, I think. Maybe you want. Oh, the 30
It's
seconds
gonna
showing
hit my stop
the
right now.
30 seconds still showing
Here's the opening bell.
upswing.
I pulled my stop to
Yeah.
break even. It's really close now, but the bell's about to ring in China.
I don't know. Yeah. But you could
It'll
easily
probably get a
automate
break
that
even.
with TradingView. Well, hey
Fine
now.
scripts.
It's impressive in the new modern era of AI. You'd be surprised. Like I said, you can get right now the source code for this. AI can do many powerful things. I'll just leave it at that. And you got a big sale on right now to get 80% off, dude. Yeah. But anybody else got any questions at all? I mean, we could watch this all night. I could ping Jonathan at 3 in the morning. He'll be sitting up. I think he's a crystal meth. I don't know how it does it. Anybody else got questions? 2.5 hours. But my point is, you could see the detail of those reports and the potential of it, and how you're able to quantify and qualify. 'Cause that's kind of like ultimately you want to do. And with the AI, being able to generate your strategy with the trading logic in there for if you have a popular broker like interactive brokers, you could probably add in the API code as well to interact with your TWS. I wouldn't be surprised you'd be able to do having a fix as well if you use fix protocol. I mean, it's just where we're at with the coding and the trading on top of it. It's just like I don't know. I mean, this looks like a really good indicator you found, Jonathan.
Yeah, it's
So,
one of the
how recent
best
was this
from
one
all the ones that I looked at. I looked at many.
that you found? Like, how long have you known about this one? Years.
Um,
Wow, that's pretty
years
nice.
for years, it's been one of
So
the
you could
best. Yeah.
just if you could automate your trades with this and set up your alerts and all your stop losses, man, you could do really good with this. This is a pretty good. That's pretty good. So the thing is, when you're trading at this level on your time frame of 30 seconds, 2 minute, 1 minute, the problem is it's kind of too sensitive. So you could get a lot of premature uh, calls. And then what happens is when you start to bank with profit, the problem is it's the commissions that eat you alive. So if you're able to, I mean, obviously, if you higher amount
Yep.
of uh, trading commission, you can lower your commissions um, quite easily. But even on interactive brokers, the commissions still can be a problem. I find that's why I like in quote unquote investing. Oh,
I think I paid 4 grand 1 week in
yeah,
commissions for
but
interactive broker.
your profit days have been absolutely mind blowing.
Yeah.
Yeah, I think the world is as
I'm
well,
still
but I
digging out of
think
Trump's
Trump's
mess.
not going to be a wild axeman like Malay,
Yeah.
you know? So I don't know. Anybody else got any questions? No, that's a pretty impressive indicator you found, Jonathan. No doubt.
So yours is more like a standard linear regression line, right? It's a
Oh,
straight
yeah.
line, but the one I was
Yeah, I
referring to
think,
is a linear regression curve.
let me just see. I
Um,
might be able to find some.
it's like a best fit line, but it curves.
Yeah, yeah, yeah,
Oh, now the short breaks down
yeah.
after it
Let
hits
me
the
just get
stop,
rid of
right?
this indicator. I'll pull up another one close to it. Yeah, that's a problem with this type of time frame.
Is yours
That's the
breaking down?
problem.
It should.
But there's no impact from China, that's for sure. So linear regression. Uh, where is the curve?
Curve. Curve.
So it's all channel. Oh, here we go. Regression
Maybe I don't
channel
have it.
curve. Let's see if this does anything. Yeah, that looks pretty good. Uh, it's a combination of both. The channels
Um, I haven't used that one.
maybe make work better. There's a combination of Fibonacci and a what do you call a Bollinger. It's a pretty good combination. Let me just check my chat.
Yeah. Some
Uh,
standard
okay, I
deviation.
think David asked about the. I think I've already answered your question, David. Yeah, so the video will be available once I get this rendered. It takes a couple hours, but I'll be posting it. Hopefully, video will survive. Um, so there's nothing else for anybody. So I'll close down the webinar. Um, I'll be on the usual channel for you, Jonathan. But this is yeah, yeah, yeah,
Right.
yeah.
Interesting.
I'm pretty happy
Interesting
with it once I
progress.
can get it all verified. Um, anybody else got any questions or comments at all? And like I said, I mean, it's 2.5 hours. I don't mind doing these long. I just worry about people watching this. Usually, you know how the doom scrolling, you get 10 seconds of their time, and that's it. Um, so I'll do it going once, 3 times, and then we'll just shut her down. So if you got any questions, type away. Let me know. Oh, I just got one. Yeah, there. Thanks for sharing the knowledge. No problem, David. Um, anybody else got any comments, questions? I do it going once. Going twice, going 2.5, going 3 times. I guess we're done. Okay, so thanks for watching. So I will end things here now, and I'll be doing more of these other other. No problem, Jeff. Thanks for joining. Thanks everyone joining and putting up with 2.5 hours. It's quite a bit, but just understand that futures and options is a really sophisticated set of knowledge to pick up. I mean, people spend years trading in futures and options. It takes them years. But the thing about with the futures and options, it's all about safety guardrails. So that's a nice thing about it. The other thing is you're not chasing return either.
Mhm.
Yeah. Well, that's part of the other
I should
problem.
have kept my stop a little wider.
So I guess we're done. I'll end the webinar. 2.5 hours in. So thanks a lot for coming out, guys. This is a really good one. Hopefully, I'll have more content on this. Just keep your eyes out on wherever you're coming in from, social media, email, or meetup or whatever. All right. So I'll leave it at that. Thanks for coming out and have yourselves a good night. See ya. Thank you. Thank you very much. Have a good night. Later. Bye.
Thanks.
Take care, Ben. Good night.